Good morning. Bonjour. So please, if you can take a seat. So during the 10 last years when I've been presenting for asset manager, mostly discussing how we can help insurers, reinsurers managing the asset. This year I decided to have a topic perhaps that is more macro high level, because there's been so many changes. Are the changes only from now, or are they the consequences of the 30 last year is always a question, but I think it's very interesting to understand where macroeconomically we see a bit the world. I don't know if you're familiar with Fidelity. So Fidelity has different company in US, in Europe, in Asia, worldwide. So in US, there is a business, the name is Fidelity Management and Research. Fidelity in US is globally $21 trillion. So, 25% of Americans have their retirement with Fidelity. And where my colleague Chris Das, who is in the room, and myself are belonging to, we do manage assets across the rest of the world. So Europe, Asia, and so on. And we do manage around $800 billion. And the specificity of our company on asset management is really, I would say, a bottom-up company. I mean, we have hundreds of analysts. We discuss with corporate, including with listed reinsurer worldwide. So the information we gather is coming really from all the discussion with corporate everywhere in the world. And we have macro people worldwide. And as we do manage for long-dated investor, does not work. Long-dated investor like pension, where duration could be 50 years, 60 years, and so on. We need to, to really to try to build the best view, the best analysis. We can, of course, as everybody, we can do mistakes, but that's our art to try really to understand what's happening. I don't know if you can read, but I will summarize, and after we go in the detail a bit of what we see in our regions. In US, effectively, we have seen all this politics around tariff. Perhaps that for many years, there was no tariff on any good entering US, and there is a kind of rebalancement to get a certain level of tariff. In the contrary, we're putting some tariff on American goods. So after you could agree or not with that, but somewhere there was a disequilibrium in the way the tariff were done. And we could think there is a high tariff, but in practice, we today estimate the tariff perhaps is move up to 90% and will come down to 15% very quickly. And we will see in some graph, there is redirection of demand. There is transshipment. People try to arbitrate. If there is a country with a lower tariff, they will send to the country first to the lower tariffs, and it will move to US. The globalization makes that you cannot put tariff or sanction, whatever. There is always a way to get everything moving. And in the insurance world, we know that. It's about how making the best of all jurisdictions. So this tariff will go down. But already on a monthly basis, they get 25 billion more as tax revenue. So in practice, it's kind of high. Of course, during this first semester, there has been all this move on tariff. And during the second semester, the economy does not adapt in 6 months. We think there will be a slowdown in US. But in practice, if you look on the longer run, there will be a reequilibrium happening. Regarding the rate level in practice, is driving all the currency, all the trading, and so on. In US, our view, the Fed will cut the rates. We will see a few reasons for that. In Europe as well, there is currently a big disinflationary impact. Is the good, for example, we're going from China to US. They don't go to China, they go to Europe. So in practice today, there is a deflationary impact in continental Europe. So UK is another, they are not in this Europe, but in continental Europe, you have a massive import coming from Asia because all the goods they were going to US. US, it's too much expensive. Up, they go to Europe. So there is a deflationary impact. So ECB, we go on cutting the rate as well in Europe. China, there is a big stabilization happening. During the last year, they have overcapacity. They have been reducing the capacity in specific sector, but they adapt very, very, very quickly. The rhythm of adaptation of Asian, if you take only AI, is, I don't know, I don't have a scale, but there are 100 times quicker than in Western country. It's changing very, very quickly. Every technology is adapted very quickly. So they adapt all their economy very quickly. And we, on asset allocation, what's happening, we are going to look in a bit more details. So each time you have a question, a comment, you don't agree, or feel free to raise the hand. I mean, it's not only me speaking. I try to share some view, and there is no one truth. So when our teams look globally, in practice, really, you can see that US, Europe, for the time being, from an economic perspective development, we consider that's not where we need to put our money perhaps more carefully. We have a downside view on the level of risk of US, Europe, deglobalization is really happening. And you see we have some UK, Japan in the OECD country could resist on the short run, but emerging market, China, India, are incredibly going quickly here. I know. Yeah, if you look, for example, at GDP of G7, is already 5-6 points behind, the BRICS. So the acceleration is very quick and is reinforced by everything what is happening since COVID, this kind of deglobalization, and of course geopolitical tension are accelerating that. But it gives some idea macro level what's really happening, and we will deep dive in all these different areas. When you look at global growth, you can see that the GDP, is growing steadily, but you can see that in China how quickly it can move up. Other countries are lower. So in nominal term, is growing very quickly. The inflation, you can see in China the inflation is very low, also negative. They have some structural problem because they are overcapacity. 44% of their GDP coming from industry, whereas in Occidental world is less than 20%, far less than 20%. So they need to reduce consumption or to redirect consumption, but the inflation is very low. Whereas in other countries, it's quite difficult to define the duration. So in economic area, we will have thought that inflation welcome back, but because of this redirection of goods that is happening during the 4-5 last months, there is this disinflationary pressure. Whereas in other countries that are smaller or closer, like UK, there is not this move happening. And you can see as well that in US inflation will be high, and the inflation will have a strong impact in this country. In continental Europe, is simple, it's quite big, and you can forbid. It's impossible to forbid, things to come from either Africa or China and so on. It's impossible to control all of that. And there are many countries, where it's easy to enter. For example, most of the ports in Greece belong to China, so it's easy for them to bring everything. So, but currently, when you look at the picture in Europe, you have Southern Europe, like Portugal, Spain, Italy, and Greece, who are doing very well, better than France, Germany, and Nordics. They had to restructure 15, 20 years ago. There is a kind of change in the countries that currently are doing well in Europe. Let's go to US. Financial markets are driven by US. So it's very interesting to see what's happening. Here are two most important scenario are stagflation and slowdown. So what does it mean? It means that very high inflation or perhaps a bit, perhaps 2.5% inflation is really depending, but we think really inflation is important, and there will be a slowdown. Currently, there is a slowdown happening because, of course, all this change of tariff have an impact, and the time for company to change all their chain, the time for all the company to adapt and so on, is longer. It's not a few months. It take 1 year, many years, but we see already this move, of many industrial that were producing outside US coming back to US. There is really this big move happening. So that's the scenario. Recession scenario, in our perspective, is down because currently, and we're going to see that, after having done this impact, now the Trump administration is going to produce a tax stimulus. So if you look in practice, I will not say, it's kind of clever. You put the negative side first, it impacts everybody, and after you put the positive, tax stimulus for corporate and taxpayers. So in practice, in the 12 coming months, people will pay less tax or will receive check. So it will change the nature of the consumption in US. So first point, tax. So you have here, there has been so many tax on different countries. But in April, the level when you were in average were around 24%. And immediately all the corporates, everybody, either, pre-stock a lot. You have seen massive corporate buying a lot in Asia, and after now they are changing, redirecting where they buy and so on. So it's been a move. Now we are already 19%, is going down to 16%. We think at the end perhaps it will be it will be 15%, but from a period where it was 2 to 4% is already a big change. And you have seen that the usage of tariff with some country, at the end has the opposite effect. When you look at the big country like India or China, where Trump wanted to use that to ask them not to buy Russian oil, practice is doing the contrary, they buy more. So, and they say, and in practice, when you look, for example, India, you go in details, the 50% is only a few sectors. All subsidiary of US company in India that are mostly services are not impacted by tariff. Pharmaceutical is not impacted by tariff. And when you look, it's only the sector where the family of the Prime Minister of India is close to that has a tariff. So it's very, very precise. So when you go in the details, you see that when you see a big number, but in practice, which sector is going to impact, will be like Europe, for example, all the aviation sector has not been impacted because the US company buy European airplanes and so on. So it's very, you need to go in the details to look at that. A primary concern in US today is the debt. The deficit and the debt. For the time being, level of interest payment and so on. And we will see the main concern of all Occidental countries is the level of debt. Really. Because you need to think with buying debt. The two main buyers of US T-notes, which country were the two main buyers? China and Japan. Okay, in 2024, when the currency moved a lot, in Japan, the sport was I borrow in Japanese yen, low rate, and I buy T-notes. Okay, when the market, and you buy 20, 30 years. When suddenly, the currency move, the slope of the rate is moving, massive loss. In Japan, they have been selling all their exposure to US. China decided 5 years ago to stop all their US, and they were holding, 1/3 or 40% of the US. So who is going to buy this debt? That's a main problem, and that's why here the yields are moving up. The spread is moving because they are selling, and there is no buyer. Well, it could be an investment opportunity, of course, we are going to see, but you need to think, when you act with certain country, you need to look all directions. And so the level of debt is increasing. So if you want to have some similarities, it's a bit like France, Italy in Europe, or Greece when Greece bankrupt, 10 years ago. So you give an idea of the acceptance of institutional investor versus this level of debt. when I look in certain country in Europe, I think about some German insurer. When they analyze debt for them, UK, France, US is high yield. From Govis perspective, is high yield. When I work with insurer in in China or Hong Kong, they look at it, it's already high yield. What is the level of rate today in China? 1.6, 1.7%. You see the difference? So you measure all these and the people in this country, they apply the metrics that, Solvency II in Europe force insurers to apply. So when you look from this angle, the world is changing. Some German client who ask us to exclude France, UK, high yield. So the perception of the world, is really changing. The big beautiful bill of Trump, and people ask, why is it so big? Why is he doing that? Because currently, he has changed the tariff. Each month is $20 to $30 billion more coming to US, and in parallel, he's redistributing that as tax cut on corporate of people. That's a stimulus. First you change, and secondly you stimulate the consumption, you stimulate the local investment. If you are globally, it makes sense from an economic perspective. Of course, it's done so abruptly, so rapid. But why is it so rapid? Because in US, it's always dictated by the next election. The half term is next year. So you need to get all the bad things happening first, then get the stimulus, fiscal stimulus and tax stimulus to make the thing better. That's why it's so quick and so volatile. I'm not an expert of that. What I see is the consequences of what's happening today and how economically the other, react. So I'm not an expert in US. Huh? Yeah? Then, very interestingly, when you look in detail, US has already a very closed economy. When you look at how much of the GDP is exposed to other countries, is only 2.5%. It's not that big. Huh? People look from the perspective of here. But for example, when you go in US and you look at the small, medium cap size company, they are pretty not exposed to, they are only exposed to US. So it's a very closed economy. People get the feeling if you go to UK, France, Germany, it's more open. The GDP is really depending a lot of the other country. In US, the exposure to the rest of the world is kind of limited. And of course, the trade balance is mostly with China and Europe. So if economically, as Trump, you think they are enemies, because I think there is a kind of vision of binary, the two first enemies are China, Europe. So that's why you can consider that the two countries where has been perhaps larger focus. And you can see perhaps India is pretty not sensitive to US. There are some impact, but it's very limited. So the power that economically you can have on all these different countries, always depending on what is the trading you are doing with this country. So people speak a lot, but the impact might be more limited, It's mostly Europe, that's why we speak a lot in Europe, but because the large corporate or some large industry are exposed to. That's it. But there's been big move. Look this first chart. Look in June versus last year, the trading with China been reduced here from 14 points to 8 points. Corporate are very reactive in US, So it changed a lot. And when you look here, for example, US with Canada, big move as well. You know, everybody look at the tariff. You know, it's open market. It goes quite quickly. Adaptation has been here very quick. When after you look at the trade, the new tax level, what is the tax coming from import? Look here, it's not yet this chart, sorry. Here's the uncertainty. Of course, everybody was stressed, but after he moved down very quickly. You know, of course, people react because there was a kind of consensus. Now, who likes the changes? So when change happening, of course, it's shocking everybody. But when you look at the capex, so how much the corporate are willing to invest, it come back to normality. Here, that's on the Fed. So we are already estimating here that the Fed is going to cut the rate, and it was already what you can see in the rate market, the estimation of all the market when you look at the futures. So in practice, there will be some cut. CPI is around 3%. So inflation is coming, but it's not 5, 6, 7%. You know, it's 3%. It's not that high. Labor market is fine, is equilibrated. So if you look at that from a macro perspective and you compare with other countries from OECD, it's quite good. But here, I will not go into the detail because it's done by our US colleagues. I don't know that well. You know that all the people, you know, from the FOMC, the people who are deciding about the cut, and there are different camps. There are the camps who want to cut. There are the camps of the guy who want stability. Some others who want to increase. But in practice, our team estimates that when you look at all the consensus and all the surveys and so on, that really the rate are going to be cut. I'm not going in the detail of all of that, but in practice for US, you can see inflation around 3%. Rate are going to be cut. The market is adjusting very quickly when you look at all the import balance. So each month, 20 to 30 billion more coming, and the tax cut program over 10 years is paid by these taxes. So in practice, you can see really there is a strategy at the end looks quite equilibrated. Europe. Europe, the growth was okay in first quarter. Now it start changing. I will move to this one. So that's where here what we really think is really that the rate are going to go down again. In practice, when you are a central bank, you target inflation, but you like inflation when you have a lot of debt. Because if you have high inflation, it allows to reduce the debt. But in practice, they have a mission, you know, to try to track the inflation and to look at the growth. And what we think is, for the time being, ECB has really underestimated, you know, the disinflationary move coming from what I say, all the goods coming from Asia to Europe because they cannot be sold in US. And we really see that arriving. You know, when we discuss with corporate everywhere, but as they change where they buy. I mean, if today it's cheaper to buy from China than from another countries, they buy from it. And we see this disinflationary move. And this one is not priced in the ECB. That's why here when you look at the future says stability, but really think it will be down. The rate are going to be cut once this year, perhaps once again next year. It's for sure. It's something. For sure, we really think that something will happen. Inflation. So as I just said, inflation likely to surprise to the downside as excess, you know, East Asian goods are arriving. So that's something. And, you know, in parallel as well, China already for a few years, you know, as all, you know, the salaries and so on were moving up, they're already externalized to other countries, like to Indonesia, to Malaysia, to Vietnam and so on. So to maintain the price competitive. And they try, you know, to change, and we are going to see that in the Chinese slides. In practice, they try to develop the local consumption, you know, more. Because they were, before they had a strategy to export a lot. and now they try to favor the local consumption, but they are a bit handicapped by the property market. Yeah. You know, China is already very present. Is already present in a lot of African countries. Not only China, I mean India on the eastern side, or many countries from the BRICS are doing more in Africa, and many countries from Europe are doing far less. So it could be on farming, it could be on mining, it could be on many areas. And they do as well a lot of loans, whereas European countries and so on, they don't have any more money to do loans to African countries. So if you don't lend money, you don't have financial help. So yeah, there are some. They are really going a lot to East Asia and Africa. Alors UK. Alors UK. At the end, versus Europe is a small country. When you look economic-wise, as it's not connected to Europe, inflation is higher. It's easier to check how the goods are arriving, so inflation is higher. Unemployment, is rising. When we look at the both of England strategy, but they will have to cut the rate. If the government is spending more, you need to equilibrate, you need to help them. So rate may go down. Normally, there would not have to be any cut because the level of inflation makes you have more to increase the rate. But when you have a lot of debt, you need to find some equilibrium. And the risk premium, is really increasing. As I mentioned, when I work with a AA or AAA country in Europe, and when insurers of this country have to build, a govies portfolio, but they don't go in higher yielding govies market. Alors, of course, the capital charge is zero, but for them, France, UK, as mentioned, is a bit more dangerous. It's the same level as it was for Portugal or Greece before. So it's. There are less interest on this area, but also it makes that the place there are some opportunity. I see more Asian insurer. You will see a lot as Asian insurer are less investing in US. When they don't disinvest, they go to Europe and they go to the UK market, they go to French market, and so on. But that's a positive for Europe. That's a positive of Trump is Asian is investing more in Europe. It's something that is, and European invest more in Asia. We see really this move happening. When you look Asia, on this slide, you can see that broadly across Asia, all the country, the credit of countries is upgrading everywhere. India move to BBB, Indonesia move up, Pakistan as well move up. All countries are moving up. China, is A+. South Korea is moving up. Philippines is moving up. So we have really, upgraded of all countries in Asia. And in Asia, the dollar swap is positive. It means that, in practice, it means that all investors in the world consider that it must be upgraded. In Europe, Euro swap is negative, GBP swap is negative, the dollar swap is negative. What does it mean in practice? It means that all investors in the world consider that Euro or UK must be downgraded at least by 2 notches. It's what is priced by the market. It considers the rating agency. When the Euro swap or GBP swap is negative, I don't know if you're familiar with that. It's a measure when you look at the 10-year swap rate of corporate. So is at which rate the bank are giving money to corporate. Normally, it must be higher than the govies. No. Today, banks are giving money to corporate at a lower price than to the governments. So it's safer to give money to, we take energy company to BP or Total than to the French or UK government. So it means the investor globally considers that these companies are better managed than the government, so the yield is lower. And it's already for 1 year that. Nothing changed. So it means the rating agency normally would have to degrade UK, Eurozone, and so on. In Asia, that's the contrary. The swap is very positive. And you can see all these countries are in better investor stage. Inflation pressure as well is going down. And here they benefit from US tariff because in practice now China is selling to the rest of Asia instead of selling to US. So in practice, it reduces the inflation in Asia. So it gives more capacity for the government to invest more. If we go in the detail of China, our analysis is a control stabilization, 55%. So what it means in practice, the state do it properly. They really manage well the country and the way they try to get the local consumption growing. So their strategy works well. The only side which is still difficult is the property side. Why there was a property bull in China? In practice, it's very simple. In China, they do 10 years, 20 years plan. And before the COVID, they were planning that each year 30 to 40 million people were coming from the countryside to the towns. So they needed to create towns or, houses and buildings for these 30 million of people. And of course, with COVID, no one moved. And it was the contrary. After the COVID, the people were more reluctant to live in big towns. So in practice, it means that if you go to China, there are some towns with no inhabitants. So because of this strategy. Here, of course, it will take some time. And that's a negative part because if you have a flat in China and the value is down from 50% of the price you bought it, you are more reluctant first to sell it and secondly to consume. So that's something will take some time to absorb, and that's why here the transaction volume is not yet picking up that much in China. So that's the part that is slowing down the Chinese strategy. So it's not US, it's really the property, this property story with slowing down China. The rest, I will not say at no impact, but in comparison of the impact, that's the biggest impact in the way China economy is not growing that much. It's not the tariff and so on. So, and also they have a strategy already, which is a supply side reform to try to reduce capacity in some sectors where they were overproducing versus what is the requirement in the world. So here, that's something that is also very driven from the state. But it's something that in some European country 40, 50 years ago, it was working the same way. That's a story of policy. Japan. Japan, Japan has some inflation, something that did not have for 30, 40, 50 years. Today, you may have between 2 and 3% inflation. And you know that today the rate are up. The 30 years in Japan is around 3%. And, we see some investor in Europe buying long-term Japanese debt, And they are going to buy as well in Germany, the Bund as well, because it's moving up. So there are big changes, in the way people were allocating. So instead of buying US, they buy Japan, they buy Bund. So there is a big change of... and Japan is face inflation, which generates, some. So you can see the inflation change around here 1.5% to 2.5%, and the CPI is moving up as well. So it's something new in Japan. So they need to change their policy. But with that, it will as well allow them to reduce the debt, but also it will improve the quality of all the insurance contracts. If you have a life contract in Japan, you get 1% maximum per annum. Here, it will start being higher. Asia macro outlook, let's go quickly by country. India is doing very well. Inflation, for its... today, you can see the CPI is around 3%, so in the 3-5% range, which this kind of country is good. The balance sheet as well of the country is quite equilibrated, and that's why a country like India or China, they need to buy the Russian oil, and there will be no reason not to stop doing, because they need to keep the inflation down across the country, so they need cheap oil. Account deficit as well is lower, and in the mindset of Indian, 2011 and 12, the oil price, if you look historically, has generated a lot of strikes, a lot of problems across India. So you will never see Indian government not buying cheap oil. And there are 1.5 billion people. It's 5 times US, 3 times all Europe. So you can understand why they look for stability. And you can see as well the forex reserves moving up. Yeah, I don't succeed in. Oh, good. Yeah. So it's moving good. Indonesia as well is improving. So really, it's doing well, very well. And some country around, like Malaysia, is doing very well. So when we look from an insurance perspective, well, I put in your here. What do we see? Alors here I put the capital charge under Solvency II, and here that's several markets. So here, for example, you have European govies bonds, global bonds, investment grade, emerging market, and so on. If you are a European or US insurer, or perhaps more a lifer than a non-lifer, it was lengthening the duration on govies because the rates are going down. So that's something that we see across Europe and also Asia as well. They are lengthening duration on govies. Currently, they are buying less investment grade because investment grade in Europe and US spread are very tightened, and they invest a lot in high yield. So it's a small mid-cap market. So European high yield currently is a thematic. And I see as well more and more insurance in Europe, so non-life reinsurer buying China high yield, Asian high yield, Asia fixed income. Today they go this way. The spread are nice. The country, all the upgrading you have seen you moving up. So it's currently that's a kind of sweet spot what the investors are doing. A big problem has been what to do with US. I mean, since Trump arrived, insurers are in Europe and Asia. What do we do with US exposure? In continental Europe and in Asia, people have been reducing their exposure to US, really. Or in Asia, we say they have completely sold. Yeah, some are completely sold. For example, all Chinese insurers have sold their position exposed to US. In France, Italy, Spain, I've seen many insurers completely close their exposure to US. And when the company want to keeping their exposure to the US, they say, okay, I cannot be exposed to the large capitalization company who are going to suffer from tariff. So they go to smaller companies, small mid-cap. Or they go to private equity because they think that, okay, will be the company will benefit from the changes. Or they go to direct lending. Direct lending is a company who are financing, that's strategy financing the private equity. So they want to go to companies in US that are not exposed to tariff. But globally across continental Europe and Asia, where people until now had big exposure in terms of equity as well to US, they are reducing their exposure. And in Europe, people invest more in European stocks. And in Asia, where perhaps 10 years ago, a Hong Kongese will invest only in Hong Kong, or they go Greater Asia. When you go in different countries in Asia, they tend to enlarge the scope. A bit like in Europe, 30 years ago, a French will invest only in French stock, a German only in Germany. They go European. In Asia as well, you see that. There are some countries where it's a bit more difficult, like in the lifers in Taiwan. They have 70% of exposure outside Taiwan. They have big US exposure. And I can say, they did big losses when the currency moved by 10-15%. They were not hedged. So you have balance sheet of 100 billion down 10%. It has been violent. So that's why currently people are really, rethinking. European real estate is coming back. Well, in the UK, I don't know, but in continental Europe is coming back. Since the beginning of the year, we had, initially last year, we have seen investment from Australian, Japanese, Korean, who like investing in continental Europe, and they came back already to logistics. They came back to many, sport across continental Europe, and the real estate market has turned. For example, in France, in Germany, the real estate market is coming back very strongly. So that's an area where it's moving. And emerging market equity. So Asian, a bit everywhere. People tend to diversify. People see that their book, when you look the MSCI World on equity, 70% is US. So people want to reduce this risk. So in average, I've seen many people reducing already to 30 to 30%. In 1 year, 2 years, there's been a big move to be less exposed to US. And all the insurer who are cross-border, so who are familiar with US, Europe, Asia, are really refocusing completely to Europe and Asia. And you have seen until now no word on ESG. I mean, 90% of our client insurers, they don't speak anymore about ESG. I will not say if it's positive or negative, but I mean, it's came back a lot to what is the reality, what are the facts. So it changed a lot. So some are in Germany recently. I've been working with several insurers, so looking at the impact on climate, on capital market assumption. But it's really when you look on 20 years or 30 years, when you have a short-term balance sheet as a reinsurer or non-lifer, 1-2 years. Well, it's if there is some value to get, it makes sense. So perhaps in Germany, as there will be a lot of investment on infrastructure, it was going in because it makes sense. But it's a topic that has been far less discussed since Trump's arrival. I will move a bit only on tactically, but it's going to say what I was just saying. On equity, we are pretty neutral, but we see many people going back to equity and emerging markets. So, for example, in continental Europe, the regulation changed to divide the capital charge by 2 for equity. So it means that there are far more investment coming here. In credit, high yield, you can see high yield emerging market. That's really the part where investors are going. And it makes really sense. In European high yield, most of the default happened in 22, 23, beginning of 24. Now, I mean, the asset class is kind of clean. Emerging market debt, really, when you see the upgrade of all the country, especially in Asia, is massive. I mean, you have like, perhaps I said that last year as well. I'm working with a big insurer in Hong Kong. They have different buckets. They have emerging market, developed countries, decreasing countries, and all Europe and US are in the decreasing bucket, and you see that really on the credit side, you see that on the equity side. So really you see this move happening, and you look the market. After, in each country as well, there are different sectors to play. I know another European insurer, when they look across bond and equity and corporate, they look by sectors. So when they want to play technology, they buy global technology, they buy technology in US, As they say to me, US is technology with a bit of oil. France is Euro Disney and luxury. Germany was industry. UK is services. The people tend to invest, by looking at sectors and which part of the world are good at developing these sectors. But when people play industry, they go China, they go and so on. When the people want to play new services, they go India. That's really the bottom-up approach when you have a global portfolio. And on currency, by really think, your appreciation on emerging market will get up. The tariff is accelerating that. There will be a weakening of dollar versus the other currency. And also, it's a willingness as well from Trump. If the dollar is weaker, you can export more as well. So you need to think that. It's a bit like Europe. When you look Europe, thanks to Europe, Germany benefit from weaker country like Italy, France, and so on to get a weaker euro to export more. The same here with Trump, is getting a lower dollar will allow to export more to what you want, energy and so on. So yeah, I hope I give you a kind of idea of what we see and how we analyze the analyze. But here, that's the idea of investment. That's, I think, things I have said, but nothing specific here. But he already, the French govies moved to 4.5%. So, when you don't understand, when you are not really familiar with the country, when there is this kind of politics things happening, you think that's the end of the world, and you think everything got very dramatic. But it's my personal view. I cannot comment for other country, but the French politicians are not that good in economic and finance. So I don't know how it is in the other country, but in practice, I will do something simple. When I'm in Hong Kong, it happens that I'm advising the Hong Kong regulator as well as the Chinese, and I met a few times, some ministry in this country, like in Taiwan, they come from finance. You discuss with a guy who understands all the metrics we discussed here. Well, French ones, and I have friends working for them, it's impossible to make them understand the real world. So I think the plan that was proposed was by a first step, to reduce the deficit. But for a lot of political reasons, we have in France next year the election of the mayors in all towns and many things. Some others are going to vote against. So, it's after the impact on the bond market, of course, people are going to sell OAT. But I can say to you, I know that all French insurers are happy with that because they are going to buy French govies at low price. It's that's it. Any comment, questions? Yes? What does it mean? I don't know, it's written by my British colleague, but from what I understand, in practice, what we see is in the renewable energy sector go on being developed in both countries, in US and in Europe. So we see corporate in both areas that always makes sense from this perspective to invest in this sector. Yeah. And grid upgrade means that I don't know how to explain it. You know what is an electric grid, all the mapping of grid everywhere. So there are some upgrade to be done, in most countries. So there will be a lot of investment done to develop that. So it's a thematic in terms of investment, in terms of equities. Comment, question? Today, insurers, from what I see, they don't invest in crypto asset in Europe or Asia, or not yet. I think there are some crypto insurers and so on coming, but it's not something that is commonly used, in because not commonly used, in the insurance world. So there is no direct impact. We show investment in equity. You can play this market, and that's here something very important. So we are analysts, and in our portfolio we play that and put that globally in the topic technology. So I see that, analysts, we have a techno expert who are going to look really what makes the difference between a ChatGPT, DeepSeek, and what are the implications a bit everywhere. But it's more a thematic of investment. But I don't see really insurer putting anything here. I've seen insurer investing in gold. I see insurers today investing more in commodities because they think we are going to at the end, we know that in a monetary system, if you don't have a collateral, at some stage there are some turbulence. So they want to get some commodity exposure, gold exposure, because it's less volatile. But I did not see really some that are doing Bitcoin as something they use or any currency. That's yeah. Alors, since Trump arrived, when you look at the regulator, they stop, well, they pretty stop all discussion on sustainable discussion. You know, there was one big one on biodiversity. It has been slowed down. They would have had a change of SFDR, which is sustainable disclosure. They stop it. There was something on accounting, CSRD, linked to ESG, stopped down. So from a reporting high-level discussion is top-down, but in practice behind, the country are still developing all everything around ESG, but simply because I would say continental Europe realized that there is no oil. In continental Europe, there is pretty no oil. There is, mining, there is pretty no minerals. So if you want some autonomy at one stage, you need to get energy from the sun, the water, and so on. So when you look very behind, it's more a strategic move to consider really what you can do, where you can source energy. And a part of, we don't have uranium, but you can do nuclear energy and all the other. That's why there is this move, to be more independent from oil or gas production on the long run. Mm. But gas is important when you do photovoltaic and all the rest. You need the gas because it's not constant production. So there is still here a window. Yeah. You're perfectly right. Yeah, the sentiment in population across Europe. I suppose there are many European here. We see that. Huh? It's one of the factors. Yeah, but we see that in all the political uncertainty as there is in France, or there was during the last election in Germany, or in UK as well. A bit everywhere, the consumer are impacted by either tax increase, but lack of reduction of deficit, and a lot of things like that. So it's it's a second factor to the disinflation. Yes, of course. Good. Bon. Bah, thank you very much, all of. Last question. Yeah. Um, if you look in UK, you look at the annuities lifers, they may have between 25 and 50% of private debt. If you look at German or French insurers, it could have 10 to 20% of private debt. In practice, it's really loans that the bank were doing, but because of Basel, they cannot do it. Insurers take it. So it's really an asset class that in Europe is commonly used. Of course, it depends on the sophistication of the teams of an insurer and the culture. For example, a non-lifer in UK won't share, I have short duration, I take only bond and cash. If you go to a sophisticated reinsurer like Munich Re, Hannover, CCR, Swiss Re, and so on, they have a lot of private debt. If you go to a non-lifer in France or in Germany, I know some that have 40% of private asset on their portfolio because they consider that they need to generate, the margin are compressing already for a long time, and they are generating, half of the result from the financial portfolio. So private debt is an instrument to do it. And they have real estate, they have in Germany Schuldschein, they have US direct lending, level loan, infrastructure debt. So it's really an asset class which is in Europe is pretty common. In Asia is starting. In the large Hong Kong insurer or have a lot, start having. South Korea and Japan, they have always already a lot. So, but it's really depending, today, if you are based in one country, where in your country the bank don't offload this asset, you need to get worldwide. Europe benefit from the GFC. I was working in AXA 15 years ago, and the banks wanted to offload your portfolio, so we're going to bank taking the teams and the loans. But yeah, it's private credit, I think sometimes is you know more what you finance than when you buy a bond because they are collateral, you know more the company and so on. For example, if you do real estate debt, you know, there is a building either in London or Paris or Frankfurt, that's a collateral of the loan, you know, so it's more senior, more secured. Alors, on the papers, you could say it's sub-investment grade, but in practice, it's more senior. For the UK, I don't know if it's a concern. UK is the less diversified insurers in the world. You know, they want to have British asset. You go a lifer in UK, they have 90 to 100% of the portfolio is a UK gilt, credit, private debt, and you have only perhaps 5-10% max diversification. So the concern is more the diversification. I know some French insurers that have 5% exposure to France. You know, in Germany, this insurer have only 2% of Bund, you know, and they are far more diversified. So it's not a concern. If it's more the diversification of the book. In France or Germany, of course, if you are a local non-lifer or lifer, your liability are your local client. But they will have a big diversification of the portfolio. In UK, there is it's very concentrated. So it's more the concentration on the UK market that might be at the end, it's my personal view, and when I look at the insurer, could be a risk. If there is a big shock in UK, all balance sheet will be impacted. It's a bit like in Taiwan. In Taiwan, they have 70% of dollar, non-hedge. Boom, the currency moved by 10-15%, you suffer. UK, if there is a trouble, there is no diversification. If tomorrow the French state, bankrupt, I mean, a part of the insurer that are belonging to the state who have buying a lot of funds, most of the others, the effect will be pretty low from what I see. Yes? The clients, I know on Russian side, so I cannot speak for them. I don't see really investing in Bitcoin. What I see, but I know some reinsurer who look at Bitcoin and come to Bitcoin either to raise capital or to have liability in Bitcoin and so on. So it could be an asset class. It's a bit like commodities. You know, there was a kind of when Solvency II arrived, it was bad to have commodities. But I've seen now some insurers who have gold and so on. So for me, the feeling is they will consider it. You know, especially a reinsurer, you know, most of them are pretty innovative and they have a more open-minded, it's more a local non-lifer and so on, where for which it's more difficult. But what we see, you know, at Fidelity, we have a crypto platform in US and we're onboarding some insurer on it. You know, we're using it. So it's more the culture. Yeah. In Asia, in US, people are coming. Europe, perhaps I don't know, but I don't see. But US and Asia, it works. People are coming to the platform. Yeah. Well, thank you very much for all of you. A very good conference.